My name is Laurence Black, and I'm being joined by Tiago Fernandes. So today we're giving an overview of our upcoming guidebook. This guidebook is brought to you by Structured Products Intelligence and the Index Standard. And really one of the reasons we came up with this concept is we think that with the index proliferation we see today, there's a real need to educate investors, and investors are crying out for index information. And we were just sort of discussing this and looking at some of the recent surveys from ETF Stream. It's clear that investors want education and transparency. And this sort of this interest in indices even goes as far as the SEC. We're also questioning, do investors understand indices? And as I said, there's more than 3 million indices today. So with the expertise of Structured Products Intelligence and the Index Standard, we've developed this guidebook. Now, our guidebook will be released shortly. And what I'm going to do is just hand over to Tiago Fernandes, who will introduce himself and Structured Products Intelligence.
Okay, perfect. Okay, thank you, Laurence. Look, I think as the name says, we are a market intelligence company focused on structured products. And something I've noticed throughout the last 12 years on structured products, providing market intelligence, is that on the index space, which a lot of the index providers have been providing new indices, new research, new ways to deliver alpha to investors, they've also been targeting the structured product market. So when Laurence talked about what he was creating with the Index Standard, it made sense for us to try to basically discuss the different indices, what's their value. I think one of the feedbacks I got from the buy side is that index providers or manufacturers only create these indices to create fees, which although, of course, with more innovation comes more revenue, I think that is only a small part of why this innovation is focused on derivatives. So throughout the report, I think we're going to focus not only on the index part, which Laurence is going to do, but also how do they work with derivatives and what's exactly their added value. So thank you, Laurence.
Thank you, Tiago. So the Index Standard is an objective and independent information portal where we aim to demystify indices. And what I'm going to do now is sort of just give a little overview of the guidebook, and then I'm going to talk about some of the key trends that we've identified and some of the input. And in the guidebook, we had a lot of input from the industry. So SIBO, S&P, NASDAQ, FTSE Russell, Selective, Compass, McCube, a lot of index companies and index creators have contributed to the report. So we've got their insights and we've got their leaders' views on some of the key trends. We also give an overview of the index market. We review a number of indices on how they've performed on using some of the metrics I've developed at the Index Standard. And then we also finally talk about key trends. And Tiago mentioned some of the structured product points. And I think very interestingly there is some forward-looking analysis, and you can also see which indices are being used and which kind of structured products. So I think ESG is one thing that came up in a lot of our interviews with some of the senior leaders as being very popular. And I think that probably a lot of you on the call will recognize that. So I think, kind of interesting insights for me is I think we've actually kind of reached the stage where ESG is becoming a little bit hyped and potentially even overhyped. So there's a lot of talk about the excellent performance of the ESG indices, especially over the COVID crisis. But what in my view is actually these indices have a natural tilt towards sectors that did well in the COVID crisis. So ESG indices are naturally tilted towards healthcare and technology, and they tilt away from energy and materials. And it's kind of fairly obvious because a large manufacturing company has more scope for pollution. They have a brownfield site, so they naturally sort of do worse on the ESG scores. And hence, that's why ESG indices have done well. Now, I think everyone sort of believes that this is going to continue, but eventually some of the sector performance will mean revert, and some of these indices may not do well. So that's the first sort of insight. Secondly, there are a plethora of ways you can create an ESG index. Firstly, there's no standardization in the industry. Each index provider has their own ESG methodology. And then there's a number of different ways that you can create the index. You can screen it. You can include the best ESG companies, or you can just remove the extreme worst, getting yourself a bigger basket. You can also have some sector tilts where you remove armaments or tobacco manufacturers. And then you can run an optimization feature as well. So there's a lot of different methodologies and the ways you can create ESG indices. And investors need to be aware of this because it actually is very impactful on returns. And I have an example about that. I think just sort of moving on, Jamie Farmer at S&P believes that the COVID crisis has really brought ESG to the fore of corporates. So it's on top of their minds. And at stocks, Stephen Flagel thinks that, this is what pension funds are thinking about. So I think you've seen this wall of money going into ESG, but you now need to think about valuations, because with so much money going in there, that becomes important. And then, sort of as a point I mentioned earlier, not all ESG indices are the same. So here we compare a stocks ESG index versus an MSCI ESG index. And you can see there are some critical differences. There's a sort of 4 or 5% difference in the information technology sector. Consumer discretionary, 3%, and then sort of 4% in the communication services. And energy, again, that's quite a big difference at 1.5%. And there was a 5% performance difference in this. Now, this is really driven by a couple things. And I think one of the things in ESG is, the scoring methodologies. I'll give you an example. So stocks, FTSE, and Russell all include Amazon as being an ESG-friendly stock. MSCI don't. Now, we can have a debate about whether Amazon is ESG friendly in terms of their environmental impact with the packages and their pay scales. But, you've got a real difference in opinion in the MSCI versus the rest of the industry. And also, Amazon's fantastic performance over the COVID pandemic has driven many indices. So that's important. So that's why you have to sort of look into the underlying index. So I think ESG is very popular. And, a couple years ago, factors were all the hype. So before ESG, we had factors. So where are we on factors today? So a couple things. I think that, one, the industry has coalesced around certain factors that we think are accepted. These are value, momentum, volatility, size, and quality are quite well accepted. What I think, and this comes through in the interviews with a lot of the senior industry leaders, that factors are not sort of the answer to everything. They're not all weather. They're not they're not going to cure it. They're not going to give you positive returns all the time. What we found is that factors mean revert, and they go through periods of excess performance and underperformance. I think you'll sort of acknowledge that we've seen momentum has done very well, and value has been out of favor for sort of 13 years now. So you have to understand the factors, and you have to understand that they mean revert. But actually, there's another point that's actually really important, is that factors in their construction are, give you very different outcomes. So what we did was we looked at a couple factor indices and we highlight some of the performance discrepancies or the differences in just year to date. So in quality indices, there's an 18% difference between, a major index provider who has sort of 3 simple metrics versus an asset manager index that they've designed, and it's optimized. And there's an 18% difference in just year to date, which is, a pretty staggering number. In value, sort of a hybrid value index versus a major index provider who uses book to market, there's a 19% difference. Again, so my point here is construction matters. And then the final point is low vol. Many of you may know that low vol has struggled. I think this was pitched as the sort of be all and cure for all your indexing and investing needs. However, it struggled a little bit year to date. And also there's a 6.5% difference between two major index providers, one who uses an optimization process and the other one who uses just simply a low volatility screen. So again, construction matters. And then, what we do at the index standard, we have a number of categories when we look at indices. And here what we show is just the value factor and the quality factor. And you can see that they're very different. The quality factor in blue is a lot more robust. You can see it does better on most categories. But the value factor is quite simple. You can express it very simply, so it's quite transparent and robust. So that's a kind of a visual way to see some of the differences. And in the report, we have many of graphs like this where we highlight some of the differences of in each of these indices. And then just going back to my point, there's a 33% difference between the best and worst performing factors. So you really have to think about timing as well these days. Now, another thing that's come through is the popularity of the risk control indices. And I think Tiago will talk a little bit more about the increased use of structured products and what they are, what indices that they are using in the underlying. But I would say a couple points is I think we're actually onto the third generation of risk control indices. So let me give you some background on that. I think probably 15 years ago, risk control indices really started with just simply an equity index and a LIBOR component, and they would switch between the two. In the last couple of years, we've seen a lot of mean variance baskets that have multi-asset, and they allocate using mean variance. And then you have a volatility control layer on top of that. So it's already getting quite complex for the end investor, and I think that's why you need the guidebook to help investors understand indices. And then the generation 3 is what we're seeing now is we are seeing intraday volatility control. So you can imagine an index now can have sort of 15 components. Some can be factor indices. It's already complex for your average man in the street. Then you're using mean variance to allocate. Then you're using intraday risk control. So it can get a little complex. However, coming from the banking background, one thing I always found was there was a lot of skepticism towards risk control indices. People said, oh, they're over-engineered, they won't perform well. And I think actually one thing we look at in this report is that we try and dispel that. And we've actually found that risk control indices have done very well. So, if you're an investor and your choice was to buy the S&P or a large cap equity product from MSCI or FTSE, you would have experienced a pretty big drawdown in the COVID. And across the board, the risk control indices had drawdowns of sort of 7 to 9%. They actually did very, very well. The second thing, what we did was we also looked at all the risk control indices and we looked at their Sharpe ratios over 1, 3, and 5 years. And that, by the way, we excluded 10 years because that could include some of the back testing. And over 1, 3, 5 years, they performed better than your average benchmark, and they performed better than a 60-40 basket. So I think that's actually a real validation that these indices have done very well. And I think that, look at the 60-40 basket, that's returned about sort of 10% over the last decade. Is that going to be possible going forward? I don't think so. So I think what you'll see is structured products using risk control indices as a real alternative to the fixed income bucket that many investors have. So just as I end off on my section, 2 other points. One is thematic indices. These are very popular. We've now seen almost everyone is rolling them out. We've seen working from home. We've seen pets. These are some of the newer themes. We've seen a lot of themes on robotics, AI, cyber defense. So themes are hot. Now, one of the things we did was we sort of looked at themes and we compared them to a sector benchmark. And as you can see in the graph, they don't really perform that well. Now, why is this? Well, thematic indices have a lot of selection parameters. And what we found is by the time that theme has been indexized, a lot of the time the excess returns are gone, and you might as well just buy a sector index. We compared a lot of all the IT-related themes, such as robotics, cyber defense. We compared them to just a plain technology sector ETF. You would have done better buying the sector ETF, and the typical price is a lot cheaper. So, that's one thing. Be careful of themes. Sometimes they are a little bit overhyped. And then my final slide is, I think this is a new trend in the US market. I think the trend for decrement indices is quite well established in Europe, but it's not really well known at all in the US. And I think with rates this low, we're going to see an increase in decrement indices. And then it becomes about education to help the end investor understand what a decrement index is. And we go through this in the Index Guidebook, so I won't spend too much time about it here, but they extract a synthetic dividend, and really they help the banks with their hedging, but they also make the end product much more attractive to retail because the participation is higher. And end investors love high participations, but they need to understand some of the hype or some of the what's really happening underneath the hood, that a large dividend is being extracted. So those are some of the key trends that we found from some of our research and from some interviews from SIBO, FTSE, Russell, and Selective, and many other large players. I'm now going to hand over to Tiago, who will take us through the structured products piece. Tiago, over to you.
Yeah, thank you, Laurence. Look, I know probably you're already thinking, wow, it's a lot of information, a lot of different type of indices and different performances, and now we're just introducing another complexity, structured products and derivatives, and why are they used with different indices. But I think before we go to that level, what I want to do on this short presentation is not only showing you some of the key trends, but also tell you exactly how did we arrive where we are at the moment. I think for that, let me show you some of the US structured product markets overview. I think if you look at both charts, I think it's quite important to understand it. And I think 2020 is a mixed year. At the end of the day, you had the COVID crisis. A lot of people in the beginning were talking how structured products were going to perform really bad, but that's not what happened. Protection, soft protection, and the capital protected products, that they guaranteed the capital, and with a higher volatility, it also means more sales and more product, as you can see on the left side, where we can see that 2020 is going to be a record year for structured products in the US. Nevertheless, they were much less profitable for investment banks who had big losses on their trading books. On the right, you can see that indices are still the majority of the market. Again, today we're going only to show structured notes and market-linked CDs. So we're excluding insurance market, but it's our intention for the next guidebook to also include that data. Now, on this, I think it's also important to highlight is, why are structured products using indices? I mentioned in the beginning, and through my many years of conversations with the buy side, a lot of the buy side looks at structured products using only stocks. But selling structured products linked to indices have clearly one function, and of course, is marketing. It's much easier to follow the S&P 500, getting the data. It also offers more diversification. And the one thing you will see on these slides is that they focus on providing growth. Okay. Nevertheless, something that I also want to highlight is that every year since interest rates started to decrease, and since 2007, we see a growth of indices used to provide income to clients. And I think that's a trend that we will see in the following year. And here is a good chart to showcase that. Again, with a higher implied volatility during 2020, we actually saw a simplification to market cap indices. So the S&P 500, the Eurostoxx 50, followed by a rapid decrease on the risk control and multi-asset market-linked CDs. And I think something that you in the US structured products have been listening is that a lot of the manufacturers who produce proprietary indices are actually reviewing their market-linked CDs. And I think that's probably something which we're going to see. Less market-linked CDs, but that doesn't mean, as Laurence said, that that's not going to be a space. As we also, Laurence mentioned, is these indices actually performed quite well during the COVID crisis. So I think what we're going to see is a shift from market-linked CDs to FIAs, the fixed index annuities. And I think that's something we will continue to see, and I'll show you and I'll speak about it in a couple of slides. The other interesting aspect is that volatility created a very interesting play. What I mean is during 2020, and what you can see is that with a higher vol, a lot of clients looked at structured products in a way to obtain more growth or more income. So we saw a shift from worst offs, where you had, of course, correlation play to get more income, to go to more simplified products just linked to one index. You know, the S&P 500, the Dow Jones, the Russell 3000, and of course some European exposure like the Euro Stoxx 50 and so on. And I think that was quite an easy trade to do, and that's why we saw a considerable growth this year on structured products. But that is not what is happening now. Vol is slowing down, is decreasing, although still high with, of course, next week elections. I think this is something that that it won't be possible anymore, except if we have another COVID crisis. So I think people are now looking for a different solution. Now, I just want to showcase something here, is that first on the left, you can see the different product types that use indices, and you can see that majority, 77% is to perform growth, 20% income. But what we did is, of course, depending on different type of indices, they also provide something else when it comes to derivatives and to the optionality. So within the guides, we created a smaller table that tells a bit more of that index and what it will provide on structured products or market-linked products. And this is applicable not only for structured notes, market-linked CDs, but also to FIAs and REALers and so on. And you can see there, you know, broad market cap indices versus stocks that can offer more protection, more growth, slightly less income, and of course, lower volatility. So, and this is something we are trying to do to explain the market dynamics and how you can actually, depending on the index type, what you can obtain using derivatives. And I think I have three major trends which I want to showcase to you before we open to Q&A. I think the first one is the sector indices, second, fundamental factor indices, and the third is the market-linked CDs and risk control indices. What you see here is that excluding the benchmark indices, we saw growth from 9% to 16% on sector indices. And what's the reason behind it? It, of course, is the upside participation or the coupons obtained. On the table there, you can see the average upside participation. If you're thinking in investing in, just on the index, you'll get a 1-to-1. Using a derivative embedded on a bond, you can go from 100% to 190% participation. And I think that's something now that with vol going down, we see that this is still going to grow these sector indices, mainly on the financial sector where investors can really obtain higher income. And of course, technology, as they have slightly higher vol. The other one is the fundamental factors. And I think this is something that Laurence mentioned, but we saw a massive growth from 4% to almost 6% on fundamental factor indices. Why? I think part of the reason from Laurence is, of course, diversification and provide exposure to different factors like value, multi-factor, and quality factor. Something that we see using on factor indices is a bit of a mix. What I mean is compare with growth products, clearly trying to get higher participation on the upside, is we see still more than 100% participation, 133%. What we see is an increasing on the minimum payouts or on the protection on the downside. And I think this is something that factor indices, because of their lower vol, is something that can offer to investors. And I think that's also a play we've seen happening in structured products. Third is market-linked CDs, and I'm not sure if you're shocked, but on the graph on the left on top, you see our estimate of total sales on market-linked CDs in the US market. And if back in 2018, 2019, it were more than $3 billion, and of course, this is an estimate. We believe that this year there was only sold $1 billion. Why this massive decrease? I think, of course, is interest rates. With COVID and with the Fed decreasing interest rates to try to support the economy, market-linked CDs that offered full capital protection are quite now difficult to provide. And I think that's something that it's making manufacturers of market-linked CDs rethinking their business. I know that we already have confirmation that at least one provider is canceling their market-linked CDs business. A lot of other ones are actually reviewing their offering and their indices on market-linked CDs. And I think this is where I think we're going to see a shift in the market. Wholesalers and broker-dealers, they have a problem now, because market-linked CDs was quite an interesting product to clients more towards to the fixed income that wanted to have some participation on the potential upsides. And I think with market-linked CDs disappearing, at least for now, for the next months, I think you see wholesalers and broker-dealers looking at the insurance space. FIAs, where it's much more long-term products, which allows the manufacturers to still provide some of these indices. And I think that's something that, as Laurence mentioned, risk control are still here to stay. As you can see, they can still provide very good upside participation at the same time as providing capital protection. But I think we'll see that shift. Now, before we talked about future, I also wanted to also not giving you not only an idea of what's currently out there, but what's the potential return you can obtain. You see throughout the report that we talk about participations, coupons, capital protection, and how you can shape the returns. But what we did here is we created a Monte Carlo simulation for every typical product that is currently on sale and provide you with different scenarios. So just to give you an idea, for each product, we simulated 10,000 different scenarios of performances that could obtain. To give you an idea, together with the forecast that Laurence is going to show you, what is clearly the potential gains for each type of index, and how can you position your portfolio or your client's portfolio. So on the example 2, I think this is something we discuss, is sector indices. like the Eurostoxx banks, that's an index been using quite often. What you'll see is that on a favorable and moderate scenario, they can really provide a good return on the short term. But the downside is that, of course, if there is a big crisis, a big stress in the market, you could lose a lot of your capital. And interesting enough is, of course, on the factor indices, we also see a good return on the upside with slightly less downside risk. And the other one, the other two which I wanted to exemplify is, of course, the risk control and the thematic indices, which Laurence also mentioned. I think what we've seen is that through the market-linked CDs, clients can get a lot of protection on the downside, but on the upside, their gains are quite limited to the interest rate environment. And that's something which I think we will see going forward. So on that, Laurence, I thought we could give you the word so you can tell us more about your forecast for the next years.
Thank you very much, Tiago. So at the Index Standard, we also produce some forward-looking forecasts, and what we do in a nutshell is we take the wisdom of the crowds, we gather over 30 projections from major investment houses, and then what we do, we analyze each index, we look at those characteristics, and then we also run some simulations sort of using the wisdom of the crowd's numbers, the characteristics of that index, and then we produce some forward-looking returns. And what we can see is, firstly, on the equity side, you can expect positive returns. I don't show it here, but on the fixed income side, we expect returns over the next 10 years to be just 0.3. So, that's not a great number, right? And if you're thinking about a 60-40 basket, it's very surprising, and it probably points to why Tiago said some of the MLCD numbers have dropped because rates are so low. So with that, on sort of the US major equity market, we're expecting around about 6%, EFA 7, and EM around about 10. And then turning our attention to some of the factors, we're expecting a little bit of mean reversion, because what we've seen is that value has done very poorly and momentum's done well in the last decade. We expect that to sort of flip, where we expect momentum to get around about circa 5.5%, value 7.5%, and quality we expect a very nice solid 8%. So that concludes our presentation today. I think, Tiago, thank you very much for your insights. I really found that interesting, some of the trends in the structured products. Now, we've overrun our time a little bit, but if anyone has any questions, please do let us know. Or if you have any other questions, please contact either Tiago or myself offline, and we'll be happy to help you with your questions.
Perfect. Let's just give a couple of more seconds, just because we have the Q&A chat mode. If you have the questions, then yeah, we appreciate you attending the webinar, and I hope that you learned something from it. It's our objective to publish the Index Guidebook, which will be available to everyone in the industry in the next 2 weeks.
Great, thank you. I see a couple of people are typing questions. Hopefully we'll see whether those questions come through.
Okay. Have you seen any non-equity ESG indices in the marketplace? Non-equity ESG indices.
Yeah, I think I'll take that one. This is a big topic, and thank you for the question, Ovijit. Yeah, I think what you're seeing is a lot of people are thinking really here about fixed income. And for example, I know that there have been a couple of indices that have been launched a couple of years ago. I know that Bloomberg Barclays have collaborated with MSCI for a series of ESG fixed income indices, and I expect that you'll see more of that coming. I think fixed income indices are a hot area, and so is ESG. So I expect we'll definitely see that growing.
Yeah, I think on structured products, just as a complement, I think the green bonds, the blue bonds, I think that's where a lot of the effort in Europe has been, as to how banks can use the proceeds of structured products to help ESG projects. I think that's probably a bigger trend than non-equity ESG indices, but it's something that I've heard about. Non-equity ESG indices. Okay. Okay. Laurence, yeah, I think just so we can finish on time. I think both of us will be keen in answering any questions you have. So please feel free to get in touch.
Thank you very much, Evan.
Thank you.